What's up, everyone? Welcome to Let's Talk Markets with Dave Lauer. I am your co-host, Pink, and today we are revisiting our monthly market discussion and welcoming back Dennis Dick and Erik Smolinski. So thanks for joining us again, guys.
Thanks for having us.
Yeah, what's up, guys?
Great to be here.
Good to have you.
We were joking backstage, Dave. The topic of the day seems to be dancing or waltzing with J-Pow. How the Fed seems to have taken a shift.
Waltzing, that's nice. You know, my daughter came home from school the other day, and she was like, must have learned it in gym. She's like, waltz with me. I was like, you don't want me to do that. I was like, sorry, I gotta go waltz with Jay. Sorry, dear.
See, down here we did square dance in gym. So.
Oh yeah, that's what we did. Yeah, I can do-si-do with the best of them.
And you had to wear a handkerchief. You had a hat. You had to wear it. It's a whole thing.
Yeah,
so.
New Jersey. Yeah, we didn't have that kind of stuff.
I took 12 lessons of ballroom dancing with my wife, and we dropped out after like lesson 5 because we sucked. We didn't make it. We failed ballroom dancing.
Yeah.
Seems one of those things you either get it and it comes naturally and you start to fine tune, or you just don't get it. And
my wife would have been fine, but I have like 2 left feet when I'm dancing, so I was like dancing all over, and she was getting too injured, so she was like, "Yeah, this is over. Find another partner, maybe."
When dancing becomes a contact sport, that's a problem.
Yeah. maybe just go wine tasting next time. You know?
Yeah. Except I don't like wine. I drink beer. So I take her beer testing. Or
don't you know in Ontario, and Dennis is in Ontario, you can only get Ontario wine. And
we have good wine too. My wife
likes he only likes beer. Yeah.
I owe all those microbreweries. I like the beer. But I'm a Miller Lite guy at heart, really.
Yeah. All right. Not Labatt's.
I think as we call it, blue. Because you're American, moved to Canada, you would call it Labatt's, but it's called blue up here. Nobody in America. They call, you want a Labatt's? I'm like, what's a Labatt's? Oh, a blue. Yeah, I'll take a blue.
Yeah. I'm an expat up here. It's okay. All right, so let's talk markets. So, obviously everyone in the beginning of the year knew that by the end of the year we'd be at all-time highs, right? Everyone knew that.
For sure.
Everyone's making money. Easiest market to call ever. Actually, I think the consensus forecast for the first time was that the market was going to be negative this year. That's like never happened. And of course, we're at all-time highs. Let's see, crude. You look at crude and it's plummeting, signaling demand destruction potentially and serious problems in the economy. You look at all the economic numbers; they're looking great. At least the top line, the headline numbers look really good. The word vibesession is now officially in the dictionary. And our guests, Claudia and Kyla Scanlon, have spent a ton of time trying to understand this disconnect between economic numbers and the fact that people are really hurting and are very bearish. So, what do you guys make of all this in terms of where we've been this year and where we're at right now? Because things are. I'm joking because I don't think anyone thought we'd be at all-time highs at this point.
Just Tom Lee. Tom Lee was the only one. They give him props on CNBC every day, so that's why we all know Tom Lee called it.
Give him props.
Although Tom Lee, truthfully, last year called for a huge bull run there too, and obviously that didn't work out. So it just goes to show you, if you stay bullish long enough, Dave, you'll end up being right.
Right.
So just stay bullish long enough, and you'll end up being right.
Right.
A broken clock is right twice a day, right?
Yeah, that's right. Exactly.
It's a tough life being a perma bear. I mean, our Peter Schiffs out there.
Yeah.
It's tough to be a perma bear.
Oh, yeah.
And you know what? But you'll be right every once in a while, and you'll look like a genius when you are right. But it's tough to be a perma bear.
Yeah. So, what do you guys think? What are the markets telling us right now? Do the markets even know what's going on? Because you look at equities versus other things, and they seem pretty contradictory, even within markets.
What are you seeing, Erik?
Well, for me, it's always simple, and it's actually really fun for me to talk to you guys about this stuff because it's fascinating to get the different perspectives. But I'm a trader, right? Everybody knows that. And I take very little stock in attempting to forecast things. I look at things in terms of probabilistic outcomes, and then I try to size things based on my confidence interval on that probabilistic outcome. And something that's been fascinating to me twofold. The first one is the lagging of small caps compared to large caps and mega caps. To me, that's been one of the kind of prime trading thesis that I've been waiting for the Fed to finally start messaging a little bit of a softer approach, which then we expected, or at least I expected, that to lift small caps to some degree. And so that's been interesting to see a little bit of catch up from the Russell to the broader markets. The other thing that I find fascinating is the previous moves in VIX, where from the end of October, we were in the 20s. And then as of 3 days ago, we hit a low of 1181.
Yeah.
So it's just a massive contraction in volatility. Now, for me, there are different trade hypotheses that come up with that kind of movement. But today specifically is an interesting day because we see volatility in an uptick today. It's up 2.5%, while most of the market is still up a little bit. And a lot of people have this really defunct understanding of how equities move with volatility, where they think if equities are up, volatility is always down, and that's not the case. And today you're starting to see a little bit of volatility coming back, but we're still like below 1 year low volatility, right? The average there is like 13.6 over the past year. So all of that is to say, in terms of volatility itself, we are seeing a change in volatility paradigm where most of the year we were above 14. And just recently we're entering a new regime. So that's important to me as an options trader because volatility is the lifeblood of options. So I'm going to talk about volatility when, that comes into the conversation. And at this point, I've been very carefully keeping an eye on some of the follow-on effects from the Fed conversation, which I'm not sure if any of you would have, well, at least I didn't. I didn't expect TLT to go from a low of 82.42 at the end of October and hit 98 today. So to me, I started building a position in TLT when it was hitting down, sub 85. I didn't expect it to launch up and out as it has. So from a trading perspective, there's been no shortage of fascinating things to get involved in. And I mean, this is hands down like my best year to date, which has been kind of eye-opening to me because that was not my intention going into this year. This is one of the first years that I was actually guiding down my expectations for what I was trying to achieve. But I just kept seeing opportunity, and here we are. So yeah, in a nutshell, that's what I'm seeing.
Congratulations, Eric. It's always nice, obviously, to hear traders doing well in an environment where it has been choppy. And I think, to today's point when we opened the show, a lot of people expected this year to maybe follow 2022 and to be a rougher year. We all thought maybe we'd bounce in January. I thought it as well, but I didn't foresee that it would continue to bounce the entire year and we would get on the mega caps and almost everything, all of the losses back from 2022 in 1 year, especially when the Fed was still raising rates. Yeah. So that's interesting. What else you touched on too is multiple topics, which are so interesting. The IWM versus the broad market, where it has lagged significantly, and this correlation where we buy mega cap tech, because that works in a rising interest rate environment. And then today you have, and we'll bring this to Powell maybe because you have the official Fed pivot yesterday. And what happens today is almost predictable. And I actually had one of my best days of the year just because it was predictable, is that they were likely to sell off those mega cap tech trades where they've been hiding. So now that we have an official, pivot, you can clearly see that this is one of the most violent rotations that I have ever seen intraday, where I see a day, Microsoft down 8 points today, Netflix trading down, Meta trading down, Google trading down, Amazon trading down, across the board, all those leaders laggards today. And what is leading here today? The stocks that haven't been participating. Those IWM is having a hell of a day, up 2.41%. But the home builders are ripping. We do get Lennar earnings here coming up tonight, so we'll have to see what happens with that. But Lennar up 6%, KB Homes up 7%. Interest rate sensitive stocks. So they're basically selling the stocks they've been hiding in to now gravitate to, hey, if we're going into an officially, where we're going to start lowering rates, we've got to grab everything that is interest rate sensitive. So you're seeing the banks trading higher. You're seeing, obviously, the home builders we already talked about. The XBI was having a pretty good day and still is having a pretty good day. Lots of companies in there borrow money to obviously finance their operations. So, to finance their trials. So that's why it does well too. But clear separation happening today. It's all red and green. I'm looking at 300 stocks right now. It's half red, half green. And it's like the ones that are red are the ones that really probably wanted, or didn't need the interest rate cuts, like the Microsofts. The ones that needed it are the ones holding up really well here today.
So let's take a step back real quick. And, I assume most people listening are familiar, but just in case, yesterday, the Fed held interest rates where they're at, but the Fed's statement and then the press conference that followed signaled a couple of things. The Fed sees inflation as being under control. They are happy that there continues to be a strong job market despite rising interest rates. And if you look at the dot plot, it says rates are not going up again, but we got cuts coming, and we got cuts coming relatively soon. The market was pricing in some cuts next year. That's been moving up and up to where I think yesterday, before at least the dot plot, it was somewhere expected around May was the highest probability, I think, for the first cut. And not only now do we think we're going to see a couple of rate cuts now next year, according to the dot plot. And I haven't looked at the way the market's pricing it. I assume it moved up the date and priced in more cuts.
20 March now is the leading factor for an ease, and it's like 79%, which before the most recent statement, it was less than the majority. So it was like in the 40s, if that.
Yeah. This took the market by surprise then, Eric, is what you can clearly tell. Like I was very shocked, just watching the press conference yesterday to see like an official statement come out saying we're looking at cutting rates, because I thought, and I've said this on pre-market prep all year, the Fed isn't going to start cutting rates until the economy starts to teeter. Apparently, that is not the case. Apparently, he is willing to cut rates with stock markets at all-time highs, which is shocking to me. But maybe he wants to take his victory lap here, but it's shocking to me that he actually will consider cutting rates when the stock market is at all-time highs and the economy is doing well. I thought he would actually wait until economic data started to slow a little bit to start to cut rates, but I obviously that's not the case.
I have a question for you guys on that. Actually, one of the things I had a similar thought as you did. What impact do you guys think the election year has on this?
It's one of the first things that I thought about too. I'm not ready to say that the Fed is going to dictate policy based on a preferred candidate or not wanting to. I think I don't know, but I think that they tried to engineer a soft landing, and they think they have, right? And if they think that they have nailed the soft landing, right, they raised interest rates faster than ever before and did not crash the economy, did not crash the labor market, then if you think you've hit the soft landing, you prepare to cut without that economic collapse, because you don't want to be the cause of it if possible. So I certainly think, Eric, it's possible, and like it's hard to dismiss, but if you put yourself in the Fed's shoes and you think, look, there is no one over the last decade, I think, that you could point to that would have ever thought you could have come out of a zero interest rate environment and not crash the economy. No one, no way anyone thought this was even remotely possible. And here we are still debating it and it looks more and more likely. And yeah, people feel pain. Price increases have killed people and continue to. Wages are catching up. Inflation is the kind of thing where over time people adjust to the new price levels, and the wages finally exceed it, and it becomes less and less of an issue. But it takes years, and it's going to hurt over that time. But if you look at all of these economic numbers, they're pretty impressive. So either we still haven't felt the lagged effects and things still might fall off a cliff, which I know a lot of people think, or they just nailed the soft landing, which no one would have ever thought possible. And they're trying to kind of ease it back up. And the other side of it, which we had an interesting conversation with someone on the previous episode who goes by Peruvian Bull. And, his point was that this increase in interest rates is a killer for the federal government's budget, right? So that has to be a consideration when interest expense is hitting $1 trillion a year for the government. And that's the Fed's doing, right? And the Fed gets stuck between a rock and a hard place. Either you overwhelm the government account with interest payments, or you drop interest rates and you risk more inflation. It's a tough position to be in. I don't know if they're going to get it right, but I think that to me is a more likely political calculation than the election.
It sounds like Powell, to your point, is trying to get ahead of it, trying to get ahead of the potential damage that it does from less fiscal spending if we're going to have $1 trillion in interest that they're paying a year. Just trying to get ahead of, and again, in Canada, it's a different story too. And I think we underestimate that the soft landing occurred likely in the US more so because everybody's got a 30-year mortgage fixed.
Yeah.
And in Canada, it's a completely different story. The banks only give out 5-year max on fixed, and half the people were sitting with variables. So you saw, obviously, Canada enter an official recession last quarter with the 2 consecutive quarters of negative GDP. I can tell you, Canada's still going along, but it is a little bit slower in Canada. It's not a heavy recession, but it's an official recession. But again, people are being cautious with their spending because as their 5-year fixed, there might be somebody sitting with 2 years left, 1 year left. They know they're going from 3% on their mortgage to 7 or 8% on their mortgage. They're being a little bit more conservative. You don't have that happening in the US because people are sitting with 25 years left on their mortgage. And that major expense, which is for the normal person, their number one expense is their mortgage payment, that isn't occurring in the US. So that really has cushioned the US from feeling the impacts of those higher rates.
Yeah, that killed me when I moved here, man. Moved here with 0 interest rates. And the most I could get was a 5-year fix.
That's all you get. Yeah, you're like, what is this? What do you mean a 5-year fix?
Yeah.
What is this? I get 30 years in the U.S. No, only in the U.S.
It's okay. I'm
30 years.
I'm 2 years into my 5. So
yeah.
I think I'm sitting pretty. And in the next 2 years, they're going to bring rates pretty far down in Canada.
And I come due on my rental property. I come due in December 2024. So I have 1 more year for them to start. And my rate right now on my rental property is 1.64%. I'm like, this is just awesome. And I'm like literally like preparing to for this to go up. So I've been saving money to pay off a good chunk of this on my rental property.
Yeah.
But it's funny, I'm with Bank of Nova Scotia in Canada, and I have a 1.64% mortgage. With that same bank, I have a 5.7% GIC. So I'm literally just taking 4% from the bank every single month.
Right hand to
and
the
then
left.
Comes December when it comes due, I'm going to try to pay off a lot of that. Obviously, maybe not be able to pay off at all. But I mean, that's the difference is the banks are actually in Canada probably in better shape than a lot of these, US banks, the regionals. We went through the crisis back in March and April, and nothing has been solved there. But again, that US consumer isn't getting hit where it hits the hardest in their mortgage. And that's why I think Jay Powell has, it appears to have navigated this economy and actually have a soft landing here.
So what do you think, Eric? Do you think he nailed the soft landing? You look skeptical to me.
Well, it's 2 things that come to mind for me. The first one is it's wild to me that 2 months ago we're talking whether or not a soft landing is possible, and now there's even conversation that we're realizing it. To me, I think it's light years too early. to think that. And the second thing that just kind of caught my ear is when you were talking about the 2 quarters of negative GDP, in Canada, marking receding economy and a recession. Just reminded me of when we had that in the US in Q1 22 and Q2 22, but still no recession. So that part's, maybe you guys should just do what we did and not call it a recession, and then you're good.
Back to changing the definition.
I'm just saying. Because when you were talking about that, I was like, this makes perfect sense. 2 quarters negative GDP, recession, got it. And then I was like, oh, wait a minute. We just saw that, but it's not a recession sometimes. So
that's the truth. They change the definition. It's just like the CPI. They change the definition as they go along, the way they calculate it. We changed it a little bit here. Oh, we tweak it a little bit here. It's a little less inflationary than it was 20 years ago. A little less inflationary, a lot less inflationary than it was 20 years ago. Welcome to how the government works.
Well, so wait, let me ask you this, Dennis, then, because I haven't seen the numbers in Canada. I mean, I saw GDP, but have we seen in Canada a contraction of the labor market as well? Because, honestly, that was the justification with not calling a recession in the US, that the labor market continued to be so strong. Normally in a recession, that is one of the defining characteristics of it, that people lose their jobs. And that is where the Somm rule comes from, which is, our other monthly guest, Claudia Somm's, what she developed when she was at the Fed, which says that you measure a recession based on, an uptick in the unemployment rate of a certain amount over a certain period of lagged average movement. And so, did that happen in Canada?
Well, we rose, I was just Googling in the background to grab those numbers, and apparently we rose 0.2 percentage points in October, which is marking the 4th monthly increase in the past 6 months. So we have seen a slight,
but that would
slight uptick. We're talking 0.2 percentage points. So we're not talking like everybody not getting a job ever again, but we rose a little smidgen. So I guess that means, Dave, that it is official. We rose up 0.2%.
In a country where half of you work for the government and you can't lose your jobs, all right, that's meaningful, right?
It doesn't feel like people are hurting for jobs out there in Canada, though. I'm in Canada. I can tell you, if you want a job, you can get a job. I still see the sign at McDonald's, $17.50 an hour. Sounds pretty good. You're just starting out. When I started working, I was making $4.50 an hour, so $17.50 sounds pretty darn good.
So no, I think it's a fair point, though, Eric, that it absolutely is early to call the soft landing. I'm certainly more, I don't mean to be definitive. I'm thinking in probabilities that it even seems like it's a 50-50 at this point. It is still in and of itself, to me, mind blowing. I remember conversations over the years of zero interest rates. People talk, how do we get out of this? This is unprecedented. Can we possibly get out of this in a clean way? But look, that led to huge misallocation of resources, huge debt on behalf of the government and corporations that all has to come due in the near future at higher rates. There is a wall staring us down over the next couple of years of refinancing, both from a government and a private and corporate perspective. It does seem like it's premature, but maybe that's part of the Fed's thinking as well, is that maybe they are concerned there's a bigger crash coming and they want to get ahead of that.
Staying ahead of it. I think so. I think you're right.
I feel like there could be an argument for that if we saw a slightly different behavior from the Fed. Maybe I'm just the skeptical one here, but I feel like if the Fed was trying to take that more paused approach and to not go too far, I think, why wouldn't there have been at least one pause during this giant raising cycle to then assess leads and lags? To me, what it seems like is they needed to get as far ahead of this as humanly possible before we enter an election year so that they could then slow down. That obviously will react well across the market. And I think more than that, I was just looking at typical jobs performance around election years. And that also is influenced. So again, maybe I'm just too much tinfoil hat, but at least like the statistical side of my mind is saying there's a lot of interdependencies here. And then there's this giant overlaying factor that makes it very difficult, at least for me, to very clearly segment these different sections, because it just seems far too curious to me that the Fed has leaned as hard as they did, literally up until the very end of the year. And then now we see this completely change in tone. That I just find curious timing. Maybe you're absolutely right. Maybe it is that they now think that they might have gone too long, but part of me thinks, how could they not have thought that when mortgage rates were over 8%? When, I mean, we were there.
I mean,
and we were there for some
people,
time.
right? Like the Fed is people. They're definitely human. They make errors. We've seen
Our errors caused this, Dave. I mean, you know,
Right.
the errors keep 0%. The COVID, you know, like we've got to get the rates as low as possible because everybody's struggling. It's what caused the inflation in the first place. So it is the Fed that caused the problems of the inflation, undoubtedly. And maybe, you know, Powell's taking his victory lap now and saying, look, I've undid the damage that he did by lowering rates as much as he did. But maybe it's, you know, to Erik's point, he wants to get out on top here. Maybe he's thinking about, like, you know, the next election cycle, and maybe he's just thinking about being done too. Like, how old is Powell? I mean, maybe he's thinking, like, I can go out on top here. The person who navigated the soft landing, I don't want to give that up by having the economy fall off a cliff at the last second. So to Erik's point, maybe I got to, you know, just talk about cutting rates to make sure this market stays hot, to make sure the economy stays okay, so that I can officially go out on top saying I am the first person to actually navigate a soft landing.
Yeah. And then the next person comes in. Oh, look, they
And that is done. But the next person is set up pretty well too. I mean, if the economy starts to teeter, if the economy goes down, they can just start lowering rates as fast as they were raising rates to pop it back up again. Yeah. So like, I asked myself this question. I'm like, how can I really be bearish here now if the Fed has all these bullets in the chamber because they've raised rates so far that they can cut rates, I feel like, you know, 10 times here to help the economy out? The market, we know how much it's going to start popping up when the rates start going, you know, down. So it's hard to be a bear here, and not even a perma bear. It's hard to be bearish at all. We've run a long ways, and lots of me says take profits. It's been a pretty incredible run here. But then I look forward into 2024 and saying, well, even if the economic data starts to slow, they just start cutting rates like crazy, and it pops the rate back up again. So I don't know how you be bearish here, really, and I want to be bearish. Erik, tell me how I can be bearish.
Just start fading stuff that's high. That's easy. The trading part of my brain, it's as easy as can be, because I don't know, at least for me, I have different theses that I look to chase. Some short term, some long term. So I feel like at least for a lot of the short deltas, I still find tons of opportunities for short delta plays. Are you assume like you're fading energy and stuff like that, or stuff within energy?
I think so. Is it too late?
I don't know. I don't think now. I think the energy trade has been sold hard. I mean, a lot of those stocks I actually would look as maybe oversold, like an Oxy, where Buffett was coming in and buying it yesterday here again. I mean, it's come down significantly. A lot of these things are trading at they're trading at valuations that are indicating that we are going into a recession, really. So if we don't go into a recession, I think the oil stocks are all buy. So I think it's too late to be selling oil now. I think you had to be selling oil when everybody was talking about it going over $100, and it never happened. And that's when we've come down now to 70. So I feel like the energy trade is kind of over.
I think it depends on what you're looking at, right? Because like when I look at energy equipment and services on the 1st of December, that was trading at 333 and it hit a low of 3. There's 30 points right there. So I still find that there's plenty of things that, again, this is the beautiful part of being like a smooth brain trader, is that you guys have very great understanding of things, and I'm just shooting my shots. And if it works, it works. If it doesn't, it doesn't. I just find the cyclicality in the market right now that there is no shortage of opportunity. But I agree with you in terms of like your overall sentiment, because at least if I were to classify how I currently feel, it definitely is broad bullish, no doubt. And I think that's what the market is showing us. Even if you look at something like net highs and lows, it's had the longest run coming up essentially since the middle of the year. So there's a ton of strength out there, I think, in general. But yeah, I don't know. I'm always down to find some sick, dogly, can't pick its head up stock and then fade the shit out of it so I can make some money.
Yeah, and I mean, trading and investing are definitely two different animals. And a lot of times, I talk on the show, even on the pre-market prep show, because people have a longer time horizon. And you talk with your investing cap on, and you're in the prediction business, and you're trying to predict where markets are going. But I also wear that, Eric. I wear that day trading short-term cap with you too. My business is day trading. I invest. I have two separate accounts. I have a day trading account and I have an investing account. And that day trading account tries not to predict as much. It's kind of with you on the same thing. Like you find your setups, you look for different, opportunities. The opportunity for me as a day trader today was saying, hey, if they're going to buy all the IWM stuff, they're probably going to sell the mega cap tech where they were hiding. And that's exactly what occurred. So there was an opportunity there today as a day trader. Now, does that have follow through? And do we all of a sudden just continue to buy, IWM and sell Microsoft into the ground? I don't think so, but then that's in the prediction business. So that's, a different hat you got to wear if you're trying to make that call. I mean, I'm out of those trades, those day trades. But again, it depends which hat you want to wear. Sometimes the trading hat's a lot easier to wear than this prediction hat because sometimes it's really hard. Like today's point when you started the show, it's very hard to predict the market 6 months out. It's very hard to predict the market 6 days out.
Yeah. Well, I find the idea of trying to predict the market always to be, it's a fascinating exercise. I tend to always have different ideas, but to your point, over the course of 6 months, how much new information comes out in that time frame that then influences the future run of the market. Yeah. So to me, you can kind of only go off of what you know at a given point in time. But yeah, I hear you on the two hats part. Maybe I'm just going to slowly try to pull you more to the dark side. Get out of that investing.
Let's go trade.
Buy and hold. Yeah. Let's sling some fucking trades.
Looking for some shorts. And Eric, tell me about your trading. Do you lean to the short side more than the long side? Like on your trading, or you go, okay.
I consider myself a very loyal person, not in my trading. I'm as disloyal as they come. Like if it makes dollars, it makes sense. I don't care if it's going up, down, sideways. As soon as I see something that looks like a good risk to reward scenario, I'm on it like white on rice. Right now, I have net long deltas. That's not always the case. I almost always have some short deltas in the portfolio, pretty much always. So I'm very simple in the fact that I'm looking for opportunity. To your point, I'm not much of a day trader. Like I think trying to intraday trade, especially directionally, super hard. If I'm doing any sort of really short-term trading, it's typically trying to capture structural alpha, like variance risk premiums, something like that in the option space. That I'll attack pretty aggressively. But most of what I'm doing is anywhere from 0 DTE, which is a very small subset, all the way out to 90 plus DTE, at least in options, parlance, days to expiration, the duration of the trades. But yeah, I'm mostly just looking for things that I think provide really, really effective risk to reward ratios. And that's both long, short, and neutral.
What kind of stocks do you trade? Are you trading the mega caps? Like, are you trading, smaller stuff? Like tell me what kind of stocks you trade in the options on.
It depends. So like right now I have stuff on in IWM, SPX, TLT, VIX, Tesla, a bunch of shitty energy stocks that I was just talking to you about. I trade sector ETFs quite a bit. Pretty much anything. Here's the easiest way to describe it. Most things that have weekly expirations and options are on the table for me. Not all, but most. Because most options chains won't offer weekly expirations unless there's at least some demand for that liquidity. Yeah. So they won't offer that in a lot of stuff. So that's mostly it. But right now, my heaviest fades definitely are still in energy. It's been like that essentially since the summer. And until it starts to breathe some life into itself, I will keep fading the ever living life out of it. And then when it goes the other way, then fine, it's time for me to get out.
What about a day like today? I mean, actually, oil's having a pretty good day today.
Rallying today. Finally
Yeah, you're seeing, a significant rally overnight. We're just for the people who are listening to this delayed. We got, the USO is up 2.7%, XLE is trading up 2.9%. Is this the kind of day that spooks you, or do you add to those positions on a day like this?
No, because most of the stuff that I'm trading isn't really showing that much life today. So some of like the oil-based things, to your point, definitely are doing much better. But when I'm looking at the broader performance of energy, there's still pretty significant underperforming subsets. So the oil, gas, consumable fuels subsector is finding legs, but not everything within it. It's leaving some people behind.
So what do you guys think about this drop in the price of oil? Is Biden the greatest energy trader of our time?
Are we going to see the stickers on the pumps again? I did the stickers.
Oh, is that what he did? Is that what he was bragging about?
There should be, because they were on there when it was $4 a gallon.
Yeah.
There's been a few victory laps there.
Yeah. No, now it's dropped. That'll bring the price at the pump way down. It's going to let them refill the strategic petroleum reserve at the prices that they wanted to fill it at. A pretty impressive trade on oil. I'll give them that. I don't even know, back to what Powell's motivations are. I think you could also make the case that he just doesn't want to be the cause of a recession, if that's what he's thinking, right? Maybe it's not that I want to interfere in an upcoming election, but I don't want to be the thing that tips it.
He's scared that how many people, have come out, how many economists have come out and say he's got to stop raising rates? I feel like you got to stop raising rates too.
Yeah.
I mean, we've gone so extreme. If you keep raising rates indefinitely, it has to, there's a tipping point. There's a tipping point for sure. I feel like we crossed the tipping point, but you know what? The economy says no. So maybe he's like, we got to stop here because we don't want to cross that tipping point. And then all of a sudden, all the great work that I've done by navigating the soft landing is all undone suddenly, because we know risk happens fast. Eric, you know this too. I mean, it can come out of the blue. It can be, a war. It can be anything.
Yeah.
But, it's like we're all, happy and the VIX is sitting down at 12. And then all of a sudden, in 3 days, something happens and the VIX spikes to 17, 18, 20. And all of a sudden, the markets are selling off and we're like, wow, it went from Goldilocks to, the three bears here in a hurry. I mean, this is, what Powell is, I believe, trying to avoid. So I'm with you, Dave. I think he's just trying to get ahead of it.
Yeah. All right. So what do you guys think? I know it's impossible to predict. That's what we just spent, 10 minutes talking about.
No prediction.
I predict. I'm feeling bullish. I'm not going to lie. I'm, what you said, Eric, I'm broadly bullish. I feel like we're looking at interest rates coming down. We're looking at continued strength in the labor market, continued demand records being set on Black Friday. And I think we're going to see some incredibly strong Q4 earnings, especially in the retail space. I don't know if you want to talk about a particular retail video game store, Dennis, but we were talking a bit about that.
I love GameStop.
Yeah. Come on.
Okay, now I can talk to Dennis.
He's like, oh no, it's the GameStop hater. You know what? GameStop, actually, I trade that thing quite a bit, and it's actually showing a little bit of life here, too. I won't do any predictions, though. I'm not in the prediction game on GameStop, so we'll leave it at there.
Putting the zing and Benzinga there, though, giving us a positive rating there. So thanks for that, Dennis.
I have a quick question for you guys. What do you make on the pretty significant uptick in credit card delinquency rates?
Yeah, well, that's been ticking up here for a while, and that's a concern. I mean, if you read Zero Hedge, he's quick to point all those things out all the time.
Gotta be careful about Zero Hedge. I love those guys, but man, if you read too much of that, you'd look outside and be like, oh shit, the world's not falling apart. Insane.
Well, I don't know. You gotta show me that chart. I've heard this, but are they ticking up? From an unprecedentedly low level to something more normal, or are we seeing elevated rates relative to like past recessions?
What do we consider normal?
I don't know, but like, what, how does it rate
Got it.
relative to 2007 or 2000, for example?
Okay, so compared to 2007 Q2, delinquency rates were at 4.02%, and now they're up to 3%.
Okay.
From, to your point, a low of 1.5%. So essentially, they've doubled over the course of 22.
Okay.
Compared to the great
historically
global
low
financial
rate.
crisis.
Right.
Yeah.
Right. So it feels like they were historically low. I mean, yeah, look, people are hurting. Like, there's no doubt about it, right? Inflation has been a killer. And we came into it with I think the highest savings rates of like modern economic times. So people had a cushion to come into it.
Yeah.
But you exhaust that cushion, even if you've got your job and you've seen a little bit of wage growth relative to inflation. If you're out there shopping and consuming, which we've seen people continue to do, you're going to take on some debt, and that debt's getting more expensive. So yeah, I think it would be weird if delinquencies weren't increasing as interest rates went up to over 5%.
And again, maybe this is what Powell's trying to get ahead of. Maybe he's seeing these upticks and, hey, the economy is still strong, but we can see, the cash has been depleted. We can see the credit card, delinquency starting to rise and credit card debt increasing.
Right.
I mean, maybe that's what he's trying to get ahead of, and maybe he's right to be ahead of it. I think he is.
Well, I think, you got to do something, because I do keep a pretty close watch on just consumer behavior out of curiosity. And if you looked at the earnings releases from the banks at the beginning of this previous cycle, it showed a lot of highlights in consumer weakness. Another thing that I was reading about is just auto loan delinquency is the highest since 1994. So it's not just credit cards, but it's credit in general to varying degrees. So that stuff makes me very curious against this broader backdrop, because again, maybe I am, at least over the course of this podcast, I'm realizing that I am the skeptic, but I'm curious how that's. Yeah, well, it's crazy to me, because normally I consider myself the optimist, but I'm like, holy shit, I'm the skeptic.
I'm usually the pessimist. So we have actually completely flipped here. So, but I think you're making a valid point. I think these are things that the market worries about, and I think these are things that the Fed worries about. And I think these are the reasons, Erik, that you're bringing up that we saw a pivot yesterday. Right. I think that's so now we have to analyze, if interest rates actually start going down, don't these things get better?
Right.
Maybe they don't. Maybe we've dug the hole deep enough. Maybe that, it's just going to fall off a cliff anyways. That could happen. But I think the Fed is behind this market right now. And I learned one thing from 2013 to 2020, when we entered this quantitative easing, forever. I learned one thing from an investment standpoint is don't fight the Fed. Powell yesterday, and I've got to leave in a couple minutes, so maybe I'll just conclude with this. Powell yesterday, though, basically told us that the Fed is going to start easing, and I don't want to fight the Fed.
Yep. That is one of the most important lessons I think anyone could have gotten from markets over the last couple decades. Don't fight the Fed.
Now, with all that being said, we've come a long ways. Are we due for a check back? Probably. We have one, and we're seeing it obviously in Microsoft today. We're seeing it in some of the leaders to laggards, laggards to leaders. I love a good, contrarian strategy. I love a check back. But I think underneath demand is still going to be here for this market, because now we got the Fed behind us as well. So I do think dips are going to continue to get bought.
And it feels like a rotation here is healthy, right? It's
very healthy.
It's so concentrated in so few names. The fact that it's becoming more broad-based, I think, bodes well. And if the market is supposed to be forward-looking, then it is very much telling us next year is going to be a good year. I hope. Let's hope. But we'll see. So thanks, guys. Really appreciate you joining us. As always, really appreciate your perspectives. Really appreciate everyone here listening or watching if you're watching on YouTube. Again, you can get Let's Talk Markets on YouTube, Spotify, Apple, and Amazon. We've had a great year. We've still got a couple more episodes. We're going to crank a couple out here at the end of the year. And if you're listening to this, if we get it online before noon on Friday the 15th, Irvin is going to be having our first public town hall. We hope you can join us. Everyone is welcome to come learn what we've been up to and ask us any questions. And if you're interested in checking out Irvin Finance, hit us up, irvin.finance, join our beta. Everything's free, the best data that you can get for individual investors and fun, vibrant communities to talk and chat about different stocks with other like-minded investors. So thanks again for joining us. Pink, thanks for hosting this with me. And make sure to subscribe, give us a good rating if you like the episode. And Pink, you want to end it?
And we're about done with season 2. So definitely make sure that you subscribe and catch these last few episodes. We're going to be going out with a bang, with a zing, right, Dennis? So
the zinger. Thanks. Great conversation, Eric. Enjoyed it.
Thanks.
Thanks, guys. See you next time.